The
Second,
broadcast is now starting. All attendees are in listen-only mode.
good evening, everyone, and welcome to the May edition of Digging into the BI. This is where members from the Maryland and the DC regional chapter get together and tell you about what's going on in the member-only magazine, the BI. Sorry for being a little bit late. We were learning some new technology with GoToMeeting or GoToWebinar, and I was also late in getting stuff together. So this is what happens when you have volunteers putting it together. But we're glad you're here. Tonight, we're going to be looking at Equifax, Fastenal, TOST, and Neurocrine Biosciences. We're glad you're here, and let's just keep going. Here's our standard disclaimer that we are doing these for educational purposes. Investors, we believe, like Better Investing, you should conduct your own review and analysis of any stocks before you make a purchase decision. And we will try to alert you if we own these particular stocks in our portfolio or our club's portfolio. And if we're showing you any websites, products, or services, it's not an endorsement by the presenters or by BI for those particular websites, products, and services. We are recording this and we will get it up on YouTube. And again, we're glad you're here. So again, most of you are regulars, but this goes out onto YouTube. So in case people don't know who Better Investing are, here's our link. And up at the top, you'll see the URL for it, www.betterinvesting.org. And again, if you get these slides on live, anytime you see a blue underline, these will be able to tell you that we had, hold on, let me get this going. There we go. Any of these here, they will be able to tell you that these are hyperlinks that will take you to information about it. So we are an investment education organization focusing on long-term investing. And all of us, if you can't realize already with our struggles with some of this technology, we're all volunteers in the Mid-Atlantic region. So thank you. Here's our YouTube page that we say things will go up on. These are free. You don't have to be a member of Better Investing to get it. All we ask is that if you go there, is that go ahead and like, share, and subscribe. That's how the algorithm works over on YouTube to be able to help. As you can tell, we're trying to get to 300 subscribers, which is nothing in the world of influencers, but we'll be happy with just having more people show interest in this. All of the webinars are organized into chapters, which means you can advance to the stock you want to look at or listen to. Most of our presentations are around 13 minutes or so you can be able to take a look and compare it to your own. So consider that. For those of you that are new, we haven't really had any trouble in a while with people getting on to go to webinar, but we may with the new setup. But it's this one down here. This is the important one with the handouts. Because here you'll have the completed slide deck and the completed SSGs that you can be able to take a look at. Again, you can share them with members of your club, people that are interested in your club, just general friends. We're fine with that, no problem. So why do we do this? Well, we think that there's a lot of value in helping people that are either beginners, maybe uncertain of their judgment, either on the stock selection guide or on some of the portfolio features. How we do things is sort of a best practice for long-term fundamental investors. It's a way to also connect with other people here in the Mid-Atlantic, but you do not have to be from Maryland, D.C., or Virginia. In fact, I see several names from outside of that area. Thank you for being here. So we want to be able to promote our two model clubs in this area. And also we want to promote the Club Connect program that Cheryl will talk about in just a moment. But it's a chance to be part of the Better Investing community in the Mid-Atlantic region. And again, you don't have to be from here. We're glad you're here. Welcome. So in just over an hour, we're going to look at the two stocks that are from the member-only magazine, the stock to study and the undervalued feature. And then we're going to have two other stocks that one came from Bink, among other places, and one came, I think, from either a first cut or a ticker heat map, but they'll tell you about it when we get there. But there's just a myriad of different places that we get ideas, but most of them come through the resources that you get through your membership in Better Investing. Here's where you can be able to see what's coming up for upcoming stocks. I can see I actually have this circled around ServiceNow and Deckers when it should be above it, where we have Equifax and Neurocrine. They were announced over on March 3rd. They're a little behind. They haven't even put up the June one, so they're going to be kind of a surprise for all of us. But you can get to this site even if you're not a Better Investing member. Just a chance to see what are the stocks we're talking about. Um, if you are a member and you do want to be able to get notice and information from either the local volunteer chapter in your area, or if you want to be able to get stuff from headquarters, you can be able to do this by signing into my account up here in the upper right. It comes on over here where you can have the email product subscription information in the green circle. It opens up this screen capture on the right with all this information. Here's where the arrow to get local chapter news. If you're not in a local chapter, if there's not people there, you go to the online chapter. But it's this yellow highlight with the BI weekly newsletter. That's where you get stuff from headquarters. And before you go leave the page, make sure to hit save changes so they stick. Here's what that weekly newsletter looks like. They highlight sort of upcoming events at the national level, ticker heat map or stock up, some of our first cuts. It comes out in the close of business on Thursday. So if you signed up for it and you're not getting it, check your spam filter. Some of the things that are coming on up, actually, I don't have it marked, but this one here is the new features in GoToWebinar. So I think all of us, since we were struggling a little bit here to get things going, are going to be attending to be able to take a look. But again, there's the things with the ticker talk that's coming on up. And then there are some really good first cuts. In fact, one of them is already on Neurocrine, the undervalued feature that Ken will be talking about. But keep a look at this, great place to be able to find resources. We do put stuff up on Facebook periodically if I'm not so busy that I can't do it. But we are putting things up there. And again, if you don't have to be a member of Better Investing to do it, just sign up on Facebook. And you can be able to join, and we'll be able to put stuff up from either the DC chapter or the Maryland chapter. And again, if you're in this area and you are a club, go ahead and like us on this page. We'll like you back. And therefore, you can be able to tell us about your club and do a little humble bragging about what's going on in your club. People always like to be able to hear about it. In fact, Cheryl will tell you about what happened at the DC chapter club anniversary that just happened this last weekend. So keep that in mind as well. Brian, do you want to tell us of some of the features that we have here in the Maryland chapter?
Yep, the board meeting is Fridays. It's virtual. If you'd like to join, let us know. We'll send you an invite. We have a quarterly newsletter, and the club support coaching lessons are doing that. We're trying to get some more voluntary recruitment opportunities, and looking forward to have new members join us. Thank you.
Well, you also had a really successful SSG class, didn't you, down in Southern Maryland?
Well, there were more instructors than there were students, so we got to really take care of the students very well.
Excellent, excellent. I'm sure they benefited from it. Thank you. Cheryl, I cut this down to just all the club anniversaries, but tell us about what happened at the chapter event this last Saturday.
It was fantastic. More clubs showed up than I had requests for, so we ended up having 11 clubs all talking to one another and asking questions and learning from the answers on maybe on how to change some things in their own clubs. It really went very well. I even talked about Happy Destiny, which is a club that Kevin and Ken and I all belong to, because they are having an anniversary of 25 years as well. And I'm the sole Northern Virginia person. All the rest of them are Marylanders. But yes, everyone was very excited and happy about how it went. Also want to say that while I was at BINC, I got Doug Gerlach to agree to be the headliner on our annual meeting in June. and he is going to come and be our guest speaker. So everybody, please stay tuned. We still have to confirm the date with him, but please keep up with our events listing and join us.
Okay, thank you. Ty, why don't you tell us about your club?
Okay, Kevin. Yeah, so McNova is a Northern Virginia model investment club. We've been around since 2008. We're currently, at least this year, we're ahead of the stock market. We've got I think, a well-rounded portfolio. We've got our meetings once a month. It's on the third Tuesday, and anyone is welcome to join. You don't have to be a member of the we don't have to be a partner in the Model Investment Club to participate in the meetings, but we keep two mailing lists, one for the partners and one for other folks who are interested in. If you're interested, the link will be on the Better Investing website for the DC chapter. But the third Tuesday, we go from 7 to 9 p.m.
Thank you.
Also want to add that we're doing Palomar as the new stock.
Yeah, okay, so there it is, Palomar. All right, Ken and I are part of the other model club, the Montgomery County Model Investment Club, or MCMC. We started in 2017. We're at 7 partners. That picture of us in the lower right is actually a social where we get together with several other clubs from around the area. Because we are an online club, it gives us an opportunity to say hello and to be able to meet with some of the other people that are like-minded. We haven't figured out what our education is, but we are going to be doing a little bit of an industry comparison between Brown and Brown and Arthur J. Gallagher. We're on the third Wednesday of the month, so that means May 20th from 7 to 9. Again, like Ty said, for McNova, the same applies for MCMC. You don't have to be a member. You're welcome to be able to use that link and join us. Anyway, thank you. And Brian, tell us about your club.
Well, we're approaching the 29-year mark. I've only been there for about 6 years, and I'm glad to report that since I joined, they've kept on their ways of making money, so I haven't hindered them. So that's the best part about that. And the stock study, I believe, will be Fastenal if I do a good job tonight.
Excellent, excellent. Cheryl, why don't you tell us about Happy Destiny? And by the way, the one person who's not in our photo, she's from Richmond. So we do have another Virginian, just not a Northern Virginian.
Yes. All right. Happy Destiny's been started in 2001. I started with them much later than that. We now have 7 partners. May 15th is our next meeting. We meet on the third Friday of the month from 6:30 p.m. to about 9 p.m. There again is the link. Come and join us if you want to. It's all virtual. Education and stock studies we have a special meeting end of this week to determine that. So please come and join us. And there's our point of contact if you want to send us an email. And they're celebrating 25 years, as I said before. And here we are again. This is the Club Connect program. You can, as an individual investor or as a club, that in the club be looking for members and the individual investor looking to join a club, you can get together and there's a report you have to fill out online, and then it tries to send you a link. Well, it sends you a link, an email saying, hey, here's a club that you might be interested in. You go and you interview with them and see if they're a good fit for you and you for them. And pretty soon you're connecting.
Okay, thank you, Cheryl. So this is digging into the BI. So we do want to talk a little bit about the magazine. You can get the magazine not just through the post office, but electronically, that can be able to be seen on your computer, laptop, tablet, smartphone, or any other electronic devices. And so keep that in mind when you're going there. But let's take a look at, if you want to be able to find out more information about these featured stocks, Over here, first of all, to sign in for the mobile devices, it's this link here. It's a little different than your regular sign in. And then the other thing is that if you want to get the backing material that they have for the featured stocks, again, the undervalued feature in the stock to study, this analyst reports and other resources have that information there. So if you see that commentary in the article in the magazine, this is where you would find it online. You come here to the green where they have the View magazine issues to take a look at it. Here's one of the articles that seemed to be quite interested. People always, I think, particularly beginners and even some veterans, have trouble with understanding the PE ratios. And this just sort of walked you through. I mean, again, as they say in this article, they're just trying to be able to help you identify what's the fair value for it and how, stock price differs from the PE ratio that differs from the PEG ratio. And he sort of walks through it, I think, in a pretty simple way that that is still something that you can learn from no matter what your education level is. So keep that in mind as something to read this month. The other thing I wanted to point out is, they always have these member story columns, and there were several of them in this month because, again, we're at 75 years. And this is a club that's over in Prince George's County, so it's in the Maryland chapter, and they've been around for 20 years. They're mostly part of the Alpha Kappa Alpha sorority, their local chapter there, and they have 17 partners or members and about $250,000 in portfolio. And these member stories are written by the members and tell you a little bit about them. And I always find them kind of fascinating and like to toot the horn of any of the people from Maryland, D.C., or Virginia. So take a look at them. And if they're here, we'd love to have you make a presentation and show people what you do. Because the background on this story seemed like, be a good club to learn from. Here are some of the pictures from BINC itself in the upper right. There's Kent, Cheryl, Ken, and I when we decided, since we were the first ones to sort of get this webinar started, to be able to take a picture there. Later on, you'll see a picture of all the people at BINC that have helped out with this over the years. Over in the lower left, this photographer, I always butcher his name, Shareem, I think it is. He's with David Gardner of the Motley Fool. And this large photo up in the upper right, this is all the first timers that were here at BINC in Chicago. And as you can see, there were a boatload of them there. So congratulations. I always like going there and meeting with all the different people from around the country. The final thing is that the investor events column, always on page 51, most of these are annual meetings like ours, and most of them are actually in person. They're starting to become more in person. But this one here, the South Florida, they're doing sort of a chapter planning that's online. And same, I think, with the Houston chapter. So not as much the free education. Most of the others are in-person libraries or sort of gatherings. So keep that in mind. But good place to be able to find stuff online to be able to help learn and the like. So we've gone through a whole bunch of things there. Now let's get to the core of what we're trying to take a look at, and let's do it in core. We're going to have Cheryl Patterson and Brian Koenig show us two stocks that will be done in core SSG. Cheryl's going to start with Equifax, which is a stock to study, and then Brian's going to do one that came up on the heat map and in First Cut. So Cheryl, take it away.
All right. Thank you, Kevin. Equifax is an American multinational consumer credit reporting agency headquartered in Atlanta, Georgia, and is one of the three largest consumer credit reporting agencies, along with Experian and TransUnion. It operates in a related ecosystem with Fair Isaac, or FICO, which develops widely used credit scoring models rather than serving as a credit bureau. Next slide, please. Founded in 1899 in Atlanta as the Retail Credit Company, Equifax is the oldest of the three major U.S. credit agencies. Originally tracking merchant credit worthiness, it evolved into a massive data reporting company, rebranding to Equifax in the 1970s. By 1920, the company had offices throughout the United States and Canada. By the 60s, Retail Credit Company was one of the nation's largest credit bureaus, holding files on millions of Americans and Canadian citizens. Even though the company continued to do credit reporting, the majority of its business was making reports to insurance companies when people applied for new life, auto, fire, and medical policies. I always like to look at what the Editorial Advisory and Securities Review Committee has talked about. They addressed apparent market concerns about the rapid adoption of artificial intelligence technology. The fear is that AI might dampen long-term prospects of enterprise software marketers such as Equifax. Those concerns might help account for the recent 18-month slippage in the share price. Committee members argued the market had overreacted. Next slide, please. Equifax unique data gives customers a more complete picture, while advanced analytics with its patented AI and machine learning get quick results to the global community. In expanding its business, Equifax acquired a number of companies. In May 1994, they acquired Health Checks. In November 1994, they acquired Osborne Laboratories and Electronic Tabulating Services. Equifax is now a premier global analytic firm, despite a major 2017 data breach, which I'll talk about later. Next slide. Mainly driven by Equifax AI innovation and new products, as well as leverage Equifax cloud capabilities, first quarter revenue is up 14%, and a strong free cash flow returned $327 million to shareholders in dividends and share repurchases. In February, Equifax raised its quarterly cash dividend 12%, from 50 cents to 56 cents. The annualized dividend was $2.06 for a yield of 1% on March 6th. Next slide. Increased revenues due to verified diversified markets in government, talent, and consumer lending, as well as state government penetration and total records. Next slide, please. Mortgage growth, additional diversified markets, and consumer resilience also added to the revenue growth. Next slide. Revenue from proprietary data, almost 90% of U.S. revenue, was mainly from income and employment, core credit, commercial credit, and alternative data assets. Also, 90% of international revenue was also generated from proprietary data. Next slide, please. Second quarter 2026 margins were up by 80 basis points due to total U.S. mortgage revenue, diversified markets, international revenue, and March 2026 rates. Next slide. Highlights. Canada was up 8%, driven by ID and fraud, B2C commercial, while Asian Pac was up 6%, driven by also online B2B and commercial. B2Bs are core. Adjusted EBITDA margins 25%, up 80 base points year to year, and a strong NPI execution, leveraging new EFX cloud capabilities for NPIs and growth internationally. Next slide. The EFX growth drivers, and EFX is the ticker for Equifax, are EFX Cloud and AI, differentiated proprietary data, single data fabric, EWS growth in government supporting program integrity, NPI acceleration, indicators for mortgage, card, auto, and loan, bolt-on mergers and acquisitions, and mortgage market recovery. Equifax delivers long-term growth framework without mortgage market recovery. Next slide, please. A strong total addressable market, or TAM, and broadening revenue base from other internal services gives Equifax a larger base for revenues compared to its peers that only have a traditional credit bureau. And you can see that the red part, which is diversified markets, is growing stronger each year than the smaller where it's only a credit bureau. Next slide, please. Shifting of government requirements from federal government to state governments makes for an increasing burden on the states that Equifax programs for maintaining opportunities as well as AI to take over federal opportunities with lessening manpower to cover. Total future addressable market of $5 billion is split between federal at about 30% and state at about 70%. Next slide, please. This is a manifest investing chronicle that demonstrates that the red PAR lines is advancing into the blue shadow sweet spot. You can kind of see it's a very light blue that's right over the top of the price bars there, the green price bars. Partially due to depressed green stock prices, while the quality blue line, which is that blue line up at the top there, is back into the 80th percentile, and sales growth is currently at 6.6%. This is one of the new things that is on manifest investing, and it really brings everything great on a graph. Next slide, please. Morningstar rates Equifax as a 5-star strong buy with a fair value increase from $192.42 to $270, as well as a wide moat and exemplary capital allocation from April 22nd, 2026, that makes it harder for peers to take over their space in this industry. CFRA, which used to be Standard & Poor's, rates Equifax as a 3-star hold and 12-month target price of $210 and a 3-year projected earnings per share of 10%. Next slide, please. Here we have a value line, which a lot of our members are familiar with. You can see way up at the top on the right, dividend yield of 1%. Then if you look down to the red circle, you can see it is slightly below the value line, which is that dotted line that runs from the things that are actual to cross the estimates. If you look over to the left, there's an 18-month target price range with a low to high of 168 to 335 and a midpoint percent to middle of $252, which is a 25% increase. If you look down to the 2029 to 31 projections, you can see a high price of 360 to a low of 240, and the annual total return that goes from a low of 6% to 16% high. Now, if you look back up at the top, you'll see a blue line that goes from the PE ratio of 23.7 down to the average annual PE ratio estimate from 29 to 31 of 25. So you have a PE that is expanding there. Then if you go down to revenues and operating margin box, you can see there's a definite increase from year to year on both of those. Next slide. Here up at the upper left, you'll see the annual rates. The estimates for both revenue and earnings is 7.5%. Meanwhile, back on the lower right, product expansion is opened up, new competition, and it's saying there that the current price, these shares offer good long-term prospects. This was from February 13th. It has not come up with the May one yet. That's coming up later this year, or this month rather. Company's financial strength is B++, and the earnings predictability is 90. Next slide. Here we have long-term sales growth rates amongst the peers versus the recent quarter. You can see that their TransUnion is slightly ahead in growth rate historically, while the others are they're all pretty much closely bound together. However, if you look in the recent quarter, you can see that now Equifax is in the lead. Next slide. And here we have the same for the historic earnings per share. Again, we have here Equifax in the lead for historical, as well as up amongst the lead in the Equifax for the current latest quarter. Now, in looking at TransUnion with that 172% increase, that might have something to do with the fact that 2023 was a negative number and that they had to go play catch up. Next slide, please. And here's the historic stock price. You've got the high and the low numbers here. Up the graph up at the top, green line is sales, blue line is earnings per share. And look at that price bar. They are about on the bottom of that 52-week over all the way to the right. And in looking at the sales and earnings per share review numbers down at the bottom, sales growth was 8.2%, while earnings per share was 21.1%. Next slide. All right, here we have Verisk has gone ahead of the crowd there. Everybody else is pretty well grouped together as well, but they are well above also the industry average as well. Going to the next slide, and that was for pre-tax profit, the previous one. Looking at return on equity, we kind of find the same thing. There is everybody else kind of grouped together, and Verisk Analytics has grown in the last 5 years 164%. However, going to the next slide, looking at total and percent debt to capital, Verisk's sharp increase on last 5-year total debt and percent debt to capital is part of a reason for sharp increase for return on equity. Increasing debt generally decreases pre-tax profit margins due to higher interest expenses, while potentially increasing return on equity, or ROE, by shrinking the equity base. However, this boost to ROE is high risk, as it only benefits shareholders if the new debt generates a return higher than interest cost. Next slide. Equifax reported a significant decline in annual free cash flow for 2022, totaling approximately $0.133 billion to $1.154 billion. This sharp drop, an 84.77% decrease from 2021, was driven by a strategic decision to increase capital expenditures by $175 million to accelerate their North American cloud migration to the Equifax cloud and acquire efficient hire Law, Logic, and Data Cretito. The company continued to pay dividends. In Q1 of 2026, outstanding shares dropped slightly and the debt to capital rose. Equifax's current and quick ratios, both below 1, indicate potential short-term liquidity challenges, meaning the company has more liabilities due within the year than it has immediate liquid access to cover them. As of Q1 2026, Equifax reported a 0.61 current ratio and a 0.51 quick ratio, suggesting they may need to rely on future cash flow, revolving credit facilities, or new financing to meet short-term obligations. However, an interest coverage ratio of 5.4 for Equifax indicates a healthy financial position where operating earnings, or EBIT, cover interest expenses on debt 5.4 times over. This shows a strong capacity to meet debt obligations with a high safety margin, often seen as a sign of low financial risk. Next slide. Here we have the potential gain versus the loss. Zoning shows the buy zone goes from 137.4 to 188.0, and the current price is within that zone. You can also see the zoning range for the hold and the sell on that particular part of the graph. So the current stock price of 171.71 is in the buy zone, which equals a 4.9 to 1 upside downside and a 97.8% price appreciation potential. Next slide, please. So in conclusion, EFX is a medium-sized company with a B Morningstar financial health grade. It's a well-managed company. However, investors should remain aware of ongoing lawsuits, regulatory challenges, antitrust violations, and federal investigative demands, as well as new state reporting requirements for Medicaid recipients. It's currently undervalued, trading well below 30.2 to its 5-year average PE of 39, and it's a buy up to 188 with a buy price of 175.1 to satisfy the 3-to-1 upside downside and 15% total return, and a current price of 173.85 as of May 3rd, 2026, yesterday. EFX has a total return of 15.4% if it's sold at the high PE, and it's a worthy candidate for your research consideration. As you can see, I tried to put in the ups and the downs of this stock, and just to make investors aware of those when they are looking into a stock research. And that's the end of my report.
Thank you, Cheryl. And now, Brian Koenig, why don't you tell us all about Fastenal?
Oh, good evening. Brian Koenig, for the Maryland Chapter Director. I'm also the LIBOR Board Secretary. Currently, Fastenal will be the company tonight. It's also a member of the S&P 500. One of the reasons that I chose Fastenal, as Kevin mentioned, it's in the heat map. Although if you look at it, it's a very bright color red. That's not the reason I chose it. I've had it in one of my portfolios for a number of years. If you next slide, please. And what I am doing is I'm updating one for mine. So when you listen to my talk tonight, I'm not trying to get you to buy it. I'm trying to justify why I still have it in there and why I'm going to keep it there. One of the other things that I noticed about Fastenal, if you look at the last first cut was prepared in 2023. And so while I was preparing this, I looked at the opportunity to put in a first cut. So I'd like to promote that to anybody that's doing a SSG. Use the first cut to help them, the template to help them do that. A plug for first cut. Next slide. Fastenal began doing business a year after I graduated from high school. Incorporated in '68 in Minnesota. It's been paying dividends, quarterly dividends. Now it's paid some one-time dividends 4 times, the latest in 2023, and it's had some stock splits, 1 3 for 2 and 8 2 for 1, the latest one in 2025. Next slide. So there's some information. The current price on May 1st was a little under $45. The fiscal year ends at December. The industry is industrial distribution and the sector is industrials. It's a medium-sized company, although we'll see that it's getting near the upper limit for medium, which is kind of goes along with my reason for maybe keeping it. And it's a Morningstar grade of A. The business, it sells industrial and construction supplies throughout a lot of stores in on-site locations. One of the reasons that I like it is if we're going to have a lot of construction, the Fastenal for larger companies goes right into the customer locations, and that saves them a lot of money. Yeah, next slide, thank you. They don't just drop off the vending machines and consignment to the shelves, but they put in on on-site branches. And the peers that I got also do a similar thing. We'll see that in another slide. Inventory management and safety, supply chain right there. So the company doesn't have to have one of their people do it. Fastenal does it for them. And they call that, Fastenal calls out their Fastenal on-site. Next slide. And here are the other companies that I looked up that specifically have on-site. There's, you can see Fastenal highlighted, and then Granger was the closest one that had the people inside. A&M Industrial does it partially, but at least they appear to be better peers than the ones that came with the original SSG. Next slide. So the CEO got in there. The Q1 just got put out. Looked at the 10Q. It's improving with the broader market conditions as we've been talking about. The tariff impacts have caused a little bit of a headwind. Financial information, it's a strong cash generator. And the return on invested capital is up 31% year over year. And the 10-year average is about 28%, not too bad. And the organizational priorities you can see in there is investment tools, technology, and the customer experience and innovation are very high on the list. Next slide. And here is the end market mix, and you can see how they're lined up with heavy manufacturing and the other big manufacturing. They're doing about 75% of it. Next slide. In the company, the closing price was, like I say, about 45. The 52-week high was 50.3 low. You can see that the sales growth decided on 10 years. That's kind of matches CFRA, which gave me a 5-year earnings per share growth of 11.5%, which also matched the consensus for the long-term estimate. The earnings per share with the 11.5% will be $1.88, and the average high was 39. The current PE was 39.4. Next slide. So here we can see the sales and earnings per share. They go in reasonably up straight and parallel at 10 and 11.5%. Next slide. To evaluate management, what we looked at there was a pre-tax profit on sales, and I tried to line up the numbers above the years so we can see how they're doing. It looks like there's quite a bit of deviation, but I wanted to show there that that's between 20 and 21%. So it's relatively consistent, although that line has quite a bit of jagged to it. Next slide. Return on equity is similar, goes from 26 to 34, has a bit of a peak in 2022 and coming back down, but leveling out currently. Next slide. To evaluate management, we look at total debt, They had a spike in 2022. That was right after COVID. And then the debt to capital, which is a better indicator, after the spike in 2022, it has gone down now to about 10%, which is that's excellent for the conditions that we've been going through. Next slide. So the forecast high price, took the 39.4 for the high PE. The earnings per share from the front side was 1.88, gave me a $74.10 high price. Next slide. For the low price, I looked at the using the average low of the PE, and I came up that I chose 80% of the current price of current price is $44.90, and 80% of that about $35.90. So I made it 36. Next slide. So we put it on the assessment risk and reward scale. 74 is the high, 64 is between the hold and sell, 45.50 is between the hold and the buy, 45 or 44.90 is just below that. And down at the bottom we have 36%, which is 80% of the current price. So those are the buy sell ranges. And 3.3 to 1 for upside downside ratio. Next slide. Okay, for the 5-year potential then, we have the payout is around 76%. So 3/4 of all the information that the earnings that they have coming in, they're paying out in dividends. The dividend is 88 cents now for the year, which is no, I'm sorry, it's 96 cents. They just increased it. So the dividend yield is 2.5%. Like I say, I've owned this for so long and gone through so many brokerage when they're buying out, like TD Ameritrade and Schwab and that I have no idea what the original price was. But they're still paying 2.5%. And so when you look at the 10% appreciation, the yield of 1.9 and the current return of 12 will give me a current return of 12.5. That's not bad for a company that's within let me see, a couple, a little under 2 billion to get to the 10 billion mark and become a large company. Next slide. All right, what I'm trying to get across on this one is I'm trying to justify why I'm going to keep it. You notice that the green circles are the years that it increased, and then it leveled off on the red circles and I'm just using the high price here. So what I did was I figured out that if I take the estimated high of 2026 and say that it's $45, assume a level price of to 51. If I go through 25, 26, and 27, and then it grows again, 27 and 28. The percentages that I have, the middle green one is a 54% growth between 23 and 25, and it's from 27 to 29. If I assume also a 50% growth in the company, then what that does is if I go from the current price of $44.99 to the 2029 price of $78, that's a gain of 73%. So that's where the 73% comes from. So that tells me that it's a pretty good company in my portfolio, and I don't see any particular reason to sell it if my crystal prognosticator is working. So that's just wanted to let you know about that. Next slide. So it's a medium-sized company getting right near the changeover to a large company. It's well managed. Currently is a buy, trading near a 5-year average PE. It's closed 109. I don't think that's it. I think I needed to update that. But it is 3.3 to 1 upside downside with a 12.5% total return. And AI data centers are being built. So I think it's a dollar cost averaging opportunity if somebody wants to add it as a dividend producer. And I think that it might improve the portfolio. And I think is my story. Thank you.
Thank you, Brian. And now, after that, we're going to now have two more presentations. They're both going to be in SSG Plus. Ty's going to show us one that he saw at Bink, TOST, and then Ken's going to be able to do the undervalued feature. So let's just take it over to Ty and get us started.
All right, thanks, Kevin. So the stock that I'm presenting tonight, let me at the outset say this is a speculative stock. It's not a core holding. It was mentioned during one of the panels at Bink, and it's actually an interesting company. So I'm going to present it to you, but again, with the caution that it's a speculative stock and it's not a typical better investing stock. I also should mention that after I did the analysis, I took a small position in it. Go ahead. Next slide, please. So what is TOST? If you've been to a restaurant, you know you've seen the point of sale systems there for reservations and for when you get your check at the end of the evening. But TOST is actually a lot more than a point of sale system. It's what they characterize it as a fintech-enabled restaurant operating system. And they went profitable about a year and a half ago. So again, this is another reason why I call this a speculative stock. They had been losing money, but they're actually doing fairly well now and have been for the last 6 quarters they've reported. Next slide, please. This is their mission statement from their website and their presentations. They're trying to be the go-to operating system for all things in a restaurant, everything from point of sales to back office, tying it all together. And they also have some AI modules that plug into their basic software. So it's basically an entire back office system to help manage a restaurant. Next slide. So we only have 4.5 years of data for TOST. Mentioned that earlier. The revenue has been explosive, and I'm going to show you a price chart later on, and you can see what has happened with that. But they're still going forward. They're still doing very well. They're projecting 20 to 22% revenue growth in this year in 2026. Next slide. Also should mention the PE has now the PE has gone way down as well. The trailing PE is about 44, but the forward PE is 22. So I mentioned this earlier. They're vertically integrated. They have the hardware and the software, and they have the fintech connections to process payments in the store. So it's one-stop shopping for a restaurateur. Next slide, please. This is how they make money. There's 3 elements to it. The hardware is only 3% of revenue, but that's actually, when you look at their financials, they're providing the hardware at a slight loss. They're not making any money on the hardware in terms of profit. The big money comes from payment processing, and this is a very competitive business, low margin, but that's where 82% of their revenue comes from. When you swipe your card and it goes through their system, they have a small take on that. They also provide they require a subscription to use their software, and one of their successes has been adding modules to the software that helps the restaurant manage itself, including some AI modules. Next slide, please. So they've got a pretty good position in the U.S. As you can see here, 164,000 locations. They're doing fairly well in rolling this out, and when you see the revenue chart, you'll get a sense of how fast they've been growing. Next slide, please. This is the challenge of the market. You know, there's a lot of turnover in restaurants. Their primary market are smaller restaurants that don't have any type of an operating system. But as you know, restaurants have their own challenges. A lot of turnover of personnel and a lot of failures on startup. Next slide, please. This is their growth, what they talk about in their earnings call. These are their growth vectors where they're trying to build the business. They're going after bigger organizations. You can see some of the wins they have here: Hilton, Applebee's, Papa Murphy's. They're also trying to scale into the international, on the bottom, they're also going after smaller stores. They just rolled out a new system. You know, when you pull up to McDonald's on the car line, you get those big screens with your menu choices and someone's talking to you. They've rolled out a very similar system for fast food. So they're definitely a growing company. Next slide, please. These are the competitors. You've probably seen Square if you've been out anywhere. Square, you know, it has a lot of companies are using it, but the distinction here is that TOST is really restaurant only. It's not going after all small businesses, whereas Square is not restaurant specific. It's a point of sale processing system, but it's generic to a lot of businesses. Next slide, please. So here's their outlook. They're guiding 20 to 22% for 2026. Their margins are hoping just to keep the gross margins around 40%. I don't use EBITDA ever really for much, but there's to keep the company going when they weren't making money, they had to make a lot of promises for stock. So one of their big expenses right now is stock-based compensation. And that's why they give an EBITDA number as well as a GAAP number. The GAAP number includes the payouts they have to make for stock, but the EBITDA does not. Next slide. These are some of the risks that we're seeing. I guess the biggest one is the margins are not really big relative to other software companies, and there's a lot of pressure on that processing, on the fintech side on processing. So they've got to deal with that. There's been a little bit of a slowdown in restaurant gross business, which obviously affects their take on that because they're processing those payments, and if restaurant sales go flat, they're not growing there, or if they decline, it's going to hurt them a little bit. Next slide, please. So this is a little chart. I use Claude AI. I've got a fairly detailed prompt. I asked it for all of these metrics here. I think the revenue growth, I use 19 on the SSG. I think that's a reasonable growth factor. EPS growth rate a little bit higher. Next slide, please.
5 minutes, Ty, 5 minutes.
Yeah, so you look at the quarterly, the quarterly data here, and you can see where they first went profitable, and that was in the middle of 2024. When you have a company like this, you've got to go back to the quarterly data and see what's happening. But if you look at it, it's always improving. The earnings per share is improving, pre-tax profit is improving, and you can see the high change in sales. So this is a helpful chart, the quarterly data for this kind of a company with limited data. Next slide. And this is the trailing 4 quarters. And again, you can see where the pre-tax profit started increasing, and you can see the sales growth line. On the right-hand column, you'll notice that sales are starting to decline. They're up there, 50, 40%. They're now around 24, and as I said earlier, management is guiding to 20 to 22. Next slide, please. This is just the stock selection guide there. Next slide. This is my judgments for the preferred procedure. I use 19% for revenue growth. I assume sooner or later they'll be paying taxes. And you can see there a number of shares are actually increasing because of the stock-based compensation. Next slide, please. This is I used 40 and 10, which gave me an average of 25. The trailing PE was 44. So I've dialed down the PE fairly significantly for the purposes of doing the SSG. Next slide, please. And these are my results. It's right at the edge of the buy zone. The stock went up 1% today from what I did this yesterday. It was 29.20, I think, right now. But it's 3 to 1 buy side, upside downside, and the average PE 17. Next slide. I always like to check my numbers against Manifest Investing, and you can see they're providing a growth of 21%. Quality number is obviously low because of the history, and Manifest comes out with a par similar to what I calculated. Next slide, please. This is the price chart. I just wanted to show you at that peak back in August of last year. That's when it became apparent their huge growth was going to start to decline, and they also reported that their gross margins were going to get a little smaller. And this is one of the challenges with a growth stock. When the growth story changes, they get hammered by the market. So you can see it was up. The stock was up pretty high, around 50. And now it's down to about 29. But the good news is it seems to be coming back up. So it's not and again, I think it's the change in the growth story. And when fast growing companies become slower growers, they're still growth companies, but the market doesn't like it. Next slide, please. So conclusion, it's a speculative non-core stock. If you're interested, it's a mid-size, almost a large size company. It appears to be well managed, and it's a buy up to $29.90. That's my story.
Thank you, Ty. And welcome, Ken, to be able to bring us home with the undervalued feature Neurocrine. So take it away, Ken.
I'm doing Neurocrine Biosciences tonight. Next slide. So, as mentioned before, it is the May 2026 undervalued feature. Featured in the May issue of the magazine. It has a nice write-up to read. Next slide. So just kind of an overview. This is a company that's in the healthcare sector, and it can be considered a drug manufacturer or a biotech. Morningstar has a financial health grade of A. It's a medium-sized company. It was launched in 1992 by Wiley Vale and Lawrence Steinman. They're both neurologists at Stanford University. The company reincorporated itself in Delaware in May of 1996, so it started trading publicly. The company develops treatments for rare, under-addressed diseases, sometimes in collaboration with other pharmaceutical companies. The company underwent a significant leadership transition in October 11, 2024, when the founder, Kevin C. Gorman, retired as CEO and was succeeded by Kyle Gano. And if you invested $10,000 5 years ago, it would be worth $13,797 today. Next slide. According to the BI Security Review and Editorial Committee, the stock's valuation became more compelling after the 10.6% sell-off in mid-February, and that kind of circles that there on the price graph. The decrease followed a release of fourth quarter and full-year results that fell below analyst consensus expectations. Both fourth quarter EPS and full-year EPS were still up over 20%. Yahoo Finance reported that a PE to projected growth ratio, or PEG, of 0.3 was suggests it's undervalued. Members of the committee suggested the company's long-term growth potential appears strong and should most of the candidates in its pipeline gain regulatory approval. Next slide. So you may have seen commercials for Ingrezza, which is your flagship product. It represents a major portion of their sales. Next slide. So Ingrezza is a treatment of hyperkinetic tardive dyskinesia, or TD, a condition that is characterized by repetitive involuntary movements. TD affects about 800,000 people in the United States, and the drug has a relative low market penetration among these patients. The drug was first approved for therapy for TD patients in 2017. Its utility was later expanded in August of 2023 when it gained approval for to be treated related to Korea for Huntington disease, and that affects about 40,000 people diagnosed in the United States. It's approved for patient treatment in Japan and some other Asian countries. Sales of this drug is roughly around 2.5 billion for fiscal year 2025, and it represents 87.9% of their sales. Next slide. So the type of drug that Ingrezza is, it's considered a VMAT2 inhibitor. So to give you a sense of that market, it's growing about 7% annually, but it's roughly a $44 billion market. And it's forecasted to be a $75.6 billion market roughly by 2030. And looking at some of the players in the market, we have Neurocrine Biosciences, which is in the United States. There's also Teva, which I believe is publicly traded. They're based out of Israel. Sun Pharmaceuticals out of India. Hikma Pharmaceuticals out of the UK. Hetero out of India. Bausch Health, that company's out of Canada. Dr. Reddy's Laboratories out of India, and Paramble Pharma Solutions out of India, and Lupin out of India. So quite a bit of the competition is out of India. Next slide. Ingrezza has had its litigation. It has successfully resolved major patent litigation regarding its drug, Ingrezza. So based on the settlements from 2023, they announced that there was a resolution of the litigation at that time. So based on that settlement, the generic entry date is now March of 2038 in terms of those who want to sell generic versions of the drug. So it looks like they successfully protected their patents for at least up until that time. And then the patent protection litigation, which involved 22 FDA Orange Book listed patients, reinforced the strength of their intellectual property, which has patients extending into the late 2020s and 2030s. Next slide. The next major drug in their line that's being sold is Crinecerfont. It's a U.S. approved treatment for adults and children with classic congenital adrenal hyperplasia, or CAH, a rare condition affecting the adrenal glands. It was introduced in December of 2024, and it became the first CAH treatment approved in the last 70 years. Approximately 2,048 patients started taking the therapy in 2025, and at least 20,000 people in the country have this condition. I'm sorry, it should be Crinecerfont. Crinecerfont generated $301.2 million in sales, which is 10.5% of its 2025 sales. And they believe sales of this particular product can reach 1 billion by the year 2031. Next slide. So other products that they market are Orlissa, which was approved in 2018. It treats endometriosis pain. And then we have Orahan, which was approved in 2020. Treats heavy menstrual bleeding associated with uterine fibroids. Both of these products are marketed through AbbVie, and they receive royalty income based on the relationship that they have with AbbVie for both these drugs. So both drugs account for roughly $19 million of their FY 2025 revenues, which is 0.7% of sales. Next slide.
5 minutes. 5 minutes, Ken. 5 minutes.
Thank you. All right. So So all drugs, for most biotech companies have to go through a FDA drug approval process, and it goes through essentially 4 phases. So in looking at their pipeline, we can see that they have 2 drugs that are in phase 3, Direclidine and osavampator. And then there's another 3 drugs in the pipeline that are in phase 2 of this process. And then there are 13 other drugs which have the potential to treat that relate to endocrinology, immunology, neurology, and psychiatry that are in phase 1. Next slide. So a fairly robust pipeline. So what is Prader-Willis syndrome and hyperphagia? So Prader-Willis syndrome is a rare genetic disorder caused by the loss of active paternal genes on chromosomes 15, resulting in hypothalamic dysfunction. The key features include severe infant hypotonia or floppiness, early onset insatiable hunger, hyperphagia, leading to obesity, cognitive delays, and behavioral issues like compulsive skin picking. Next slide.
2 minutes,
So,
Kevin. 2 minutes, Ken. 2 minutes.
okay. So they have acquired Soleno Therapeutics, which markets a cure for this particular condition, which will be another big drug that will contribute to their revenue going into 2026. So that's basically the gist of the introduction of this drug for that particular therapy. Next slide. So taking a look at the value line, we can see that they're slightly undervalued based on the graph there. And I kind of circled where it's slightly below the cash flow line. You do have some modest P expansion going out 3 to 5 years. Total return over the next 3 to 5 years is 7 to 19%. They have no outstanding debt. Financial strength is a B++. Next slide. So is this a cash generator or a cash consumer? So one of the ways we can kind of figure that out is to take the cash flow per share of $13.80. It doesn't have any dividends, but we would add those in. Capital expenditures per share is $1.25, which we subtract, and we arrive at $12.55. We then take that cash flow factor of 15 that we saw in the Legends area and multiply that out, and we arrive at $188.25 per share in cash flow that is expected to have in 3 to 5 years. So it seems to be a cash generator. Next slide. And then in terms of the annual rates, they're predicting or they're estimating 9.5% for revenues, 22% for earnings. Pipeline candidates appear promising. Late-stage trials include osavampator, a compound drug being studied as a possible treatment for depressive orders and schizophrenia. The diversification approach is geared toward the discovery of medicines that have significant addressable markets and a highly unmet clinical need. So the recent dip in price kind of represents a buying opportunity. Next slide. Looking at CFRA, we can see that they have it rated as a buy over the next 12 months. It's based on the fair value rank, it's 5, which is definitely suggesting it is undervalued. They have a fair value calculation of about $208.61, where it's currently trading around $133. Next slide. So here's my judgment summary. So we can kind of see the front side graph. It looks fairly up straight and parallel. I use my judgment was 9.5 for sales, 13% for earnings. The current PE is around 28. The 5-year average PE is 37.3, so it's definitely undervalued. I use 37.3 as my high PE, 22.6 as my low PE, and the low price of $86.90. That resulted in an upside downside ratio of 4.2 to 1, with the return range of 14.4 to 19.5%, which is in line with what you saw in Value Line. It also has a relative PE of 75.7. Next slide. So in conclusion, this is a medium-sized company. It's well-managed, cash generator with strong long-term potential. I believe it's undervalued as it's trading below its 5-year average PE. It's a buy at the current price with a 4.2 to 1 upside downside ratio and a 19.5% return. And I believe it's a worthy candidate for your consideration.
Well, thank you very much, Ken. And so now that we've done that, we're going to do a little bit of a recap on all of them. It's, again, Equifax, Neurocrine, TOST, and Fastenal. And let's just go straight over here and have each of our presenters tell us why they picked those locations. Cheryl, why do you have this position here for Equifax? Oops, let me get it back there. For Equifax. And if you're speaking, we're not hearing you, so maybe you're muted. Are you there, Cheryl?
Yeah, I'm here.
Okay.
Here I am. Okay. Sorry, it would not unmute for me for who knows why. Anyway, I put Equifax. They are a mature company. They've been around since the 1890s, and but they have gotten a large kick from becoming one of the AI crowd, and they're things that are only for them. And so I believe that they're not done yet.
Okay. And Brian, tell us why you picked that location for Fastenal.
Well, it's getting near the top part of the mid-sized company, and I think that it's going to be now. It might start going down a little bit toward more explosive growth area, or in that range, depending on the AI and all the big centers, data centers that are going to be put in. If they have their on-site tools put in there, it may go down a little bit, but that's going to last just a few years until they're all built. And then I think that it's a good solid company and probably stay about right where it is.
Okay. And Ty, why do you have this location for Toast?
So Toast has gone through about a 3-year explosive growth period. It's starting to slow down, but it's not to the mature growth phase yet. So I would say it's probably halfway along the explosive growth graph. So I mentioned in the presentation, management is guiding to 20 to 22% revenue growth. And that's coming off, though, 40 and 50% annual growth. So I put it moving toward mature, but not mature yet.
Okay. And Ken, give us your reasoning for putting Neurocrine there.
Oh, Neurocrine seems to grow through a combination of organic growth, through the drugs it develops, as well as through acquisitions that it makes. So with the recent acquisition, I think that's going to bode well for the short term. And then it also has a robust drug pipeline that will contribute to growth in the future. So that's why I put it where I put it.
Okay. Thank you. Well, now it's all to you, the audience. Thank you for staying with us. And Cheryl, do you want to release a poll or shall I?
Hold on one second.
And again, what we're asking for you is not which one that you should buy today, but which one intrigued you enough that you want to do your own research. Are they able to see that? It says polls are open. I guess it is. So Good.
Yeah, we can see it.
Okay, good. And we're having some hearty votes going on right here. Oh, this is kind of a close one. Keep it up, folks. Got 50% of you are voting. Let's see if we can get it up. Let's see if we can get up over 60. There we are. All right, we're going to push. Let's see if we can get to 70. We're at 64 right now. Got a few more. A couple more votes, maybe. There we go. All right. I'm going to slowly count down. 5, 4, 3, 2, 1. Oh, we got up to 80. All right, Cheryl, you want to close it out? And now let's see. I'm going to be able. I have to share the results since I got the screen, right?
Oh, I hit
Yeah,
share.
they're up.
I'm seeing it.
Yeah,
Are you seeing
they're
it,
up,
Kent?
Kevin. Yep, I'm seeing it.
Oh, okay. All right, good. Well, it looks like we had a nice win there by by Neurocrine. Way to go, Ken. So your prize for being the winner, Ken, is to be able to come back and do another one. How about that? Anyway,
Enjoy.
do we have any questions there, Kent?
I am not seeing any at this point in time.
Okay. Well, here's a new photo since we've had the same photo for 2 years from the last time we got together with Bink. But there's a picture of us at Bink, and these are all the different people that have or will do a presentation for digging into the BI. And this is our chance to be able to bring you, if you haven't done a presentation, to be able to join us. But we have a wide range of folks there, and we're clearly missing some. But in the over 5.5 years that we've done this, we've had, I think, almost 50 different people. And I don't know if there's any other group in the better investing community that's had that many different people present. And I remember very early on, one of the directors in the DC chapter saying they really liked hearing all the different ways that people put together their stock study while still following the methodology of better investing. So please join us. If you're a regular attendee, even if you don't live in Maryland, DC, or Virginia, love to have you. If you're a little uncertain of how to do things, we have people here that can be able to help you put together. We have a template and help you do it. It's a great way to be able to promote your club, whether you're in this area or not. We'll let you promote your club and just be able to tell you what's going on. It's just really kind of great to see all the different folks that are there. In fact, one of the people in this audience, just a couple to the left on our side here, is an 18-year-old kid who started his own club over in Northern Virginia. So he was there. So my God, what a great head start he has there. But if you need to reach any of us, so there's our contact information. Kent, I'm coming back to you. Any questions? Anyone want to raise their hand? Anyone volunteering to join us?
No questions. And you'll have to check the hand raisers because.
Yeah, I did that and I didn't see any.
Okay. Very, very good. All right. Well, here's a way to be able to join our mailing list. And Carol, who's in the audience, does a nice job of getting the notices out. You don't have to be a member of BI. You don't have to be in the DC regional chapter to join this. We won't inundate you with a whole bunch. We're just going to tell you about educational events, usually 1, maybe 2 a month, and all. But again, it's a great way to stay connected with this. And again, these are free. You don't have to be a member of Better Investing to join these webinars. We're trying to do it to be able to show you how we focus on long-term fundamental investing. With that, Kent, you want to give us our regular spiel about how great volunteering is? Because it is great, by the way. Go ahead.
As you can tell, we are a group of volunteers here, and we have a really good camaraderie working together with this particular activity. And as you can see, we from the picture of the group that have been around. We've got a wide range of folks, wide range of skill levels, from beginners all the way up to 40 or so years worth of experience in doing investment analysis with Better Investing. And so if you would like to learn new skills, whether it be presentation skills, investment analysis skills, PowerPoint skills, or even how to do your own webinar, well, we can help you out with that. If you do decide to become a volunteer director, then there are some other remunerations that can come your way in the way of discounted rates on training programs like the Better Investing National Conference, as well as complimentary subscriptions to the online tools and education center activities that we have there. So good stuff if you're interested. Next slide, please.
All right, so we don't have our stocks for next month. I mean, in fact, one of the presenters, Lee, was like, "Has it come in yet?" No, they're behind. We have to find out what's going on, but we'll have a presentation, another webinar on Monday, June 1st. I'm sorry, Monday, June 1st at 7:00 Eastern. A stock to study, undervalued feature, and 2 new stocks. So please come and join us for that. The final thing is I do have these dashboards. I haven't updated in a while. Sorry about that. I finally got all the webinars up there, so at least they're current, and hopefully I'll have this one up in the next day or two. Things are busy at work, and I still have that job, so that means I have a four-letter thing that comes in the middle of me in terms of work, but we'll get it up there eventually. And again, welcome to all of you for being here. Thanks for sharing it. But here's where you can be able to see all these dashboards. And again, final pitch, this is where you'll see the YouTube video. That's a hyperlink. Make sure to download those slides as well as the completed SSGs. Again, you can share that with members of your club, anyone who you're interested in talking about investing with in your family, outside your family. Please do that. Again, these are our opinions, our judgments. We expect you to do your own research, but you can use it as a basis and compare what we do with what you do. That's how you learn to become a better investor. Any other final comments or questions that we see up there? Kent, Cheryl, see anything?
No, I'm not seeing. Oh, wait a minute. Dan Bishop has got a question, and so is Gladys. So
all right.
Please, if you want to unmute yourself so you can, we'll start with ladies first. Gladys, you got a question you need to talk to?
Actually, it looks like they're just complimenting everybody. So I agree. Thank you, Gladys, and thank you, Dan. Appreciate your compliments.
Well, after haranguing Dan for forever, he's finally going to do a presentation. So thank you very much, Dan. He's not even in this area, but he's been a regular attendee. And we got to meet again at the BINC. We saw each other at the Georgia chapter last year. So again, this is how this community works. And we're glad that Dan's participating and Gladys's participation in the past. So thank you very much.
And with the anniversary program, the clubs that I talked to, I said, told them also about digging into the BI, as well as maybe sending one of their club members to visit with us in the chapter meetings, because you get a lot out of it when you're with people that are willing to share like this organization does. So please consider that as well.
Exactly. Again, thank you, Ty, Brian, Ken, Cheryl, for being able to do presentations, and thank you, Kent, for always being here and helping out. Thank you to the audience members for being here. We look forward to seeing you next month when we'll dig into the BI again. Have a good night.
Good night, everyone.